Ed Yardeni, Yardeni Research president, has liked the U.S. market, has been right with his optimistic call. Is it time to turn the tables and go abroad, Ed, now?
Not really. I'm probably going to overstay my welcome in the United States. I've been recommending staying home rather than going global since 2010, and it's worked. I'm shocked at how well it's worked. At some point, I guess it's going to stop working, but the U.S. has a lot going for it. For example, earnings are probably going to be up quite dramatically this coming year. We're looking for $285 a share for the S&P 500. I think we're above all the strategists on the street, and that's an 18% increase. And I see the market going up on earnings, not on valuation, just on earnings alone. I think there's a lot of upside in the U.S. market. Foreign markets, not so much. As you said, it's kind of a messed up world. I'd love to be a contrarian, and I agree with your thinking along contrarian lines, but I just can't get there based on what I see in terms of the economic and political fundamentals.
What is causing earnings expectations in the U.S. in your mind to go up?
Well, my expectations have gone up for sure, and I think it's that after 3 years of the most widely anticipated recession of all times, it never happened. You know, for 3 years, there have been fears of a recession. If monetary policy tightening couldn't cause a recession, if geopolitical crises couldn't cause the price of oil to spike up and cause a recession, what's really left? Well, you know, I think you can come back, and I would come back with, I am concerned about tariffs, but I don't think that's going to lead to a recession. I think it's going to lead to some serious negotiations about freer trade. But at the end of the day, the outlook for earnings is totally dependent on the outlook for the economy, which looks great to me. And we've been talking about the roaring 2020 since 2019, and it's been roaring. Stock market record high. Earnings have actually done very well up to now, and we think they're going to be driven by productivity.
So I just posted, Ed, to my Twitter, or X as they call it. What's your best not you, but what do the viewers think is the better investment bet for next year? The U.S., Germany, China, or somewhere else? So I'd like you to answer that question. But I think you got Sarah and I's macro point. We're just observers up here. You're the expert. But our macro point was that with Germany so weak, and Brazil's a disaster, and China's stimulating, but that's probably not going to work. Is this, meaning the U.S., and I'm going to put an eagle on my shoulder and eat apple pie and a hot dog, is this the most investable market in the world because the rest of the world is still so screwed up?
Yeah, I think that's really the bottom line. And it summarizes exactly what's going on overseas. Things are a mess. And the outlook for the U.S. remains strong. The dollar's been strong. And of course, we've got a tremendous amount of consumer spending. A lot of baby boomers are retiring and spending their nest egg. So consumers have been remarkably resilient. They actually like high interest rates. And then capital spending hasn't been interest rate sensitive. Quite the contrary. It's remained very strong because a lot of it's technology. 50% of nominal capital spending in the United States is technology. And technology is something that companies really have no choice but to spend on. If you either make technology or you use technology. If you don't use technology, I think you'll be at a tremendous competitive disadvantage.
You know, Ed, you're the guy who coined the term bond vigilantes, and people are using that term again when they're looking at these higher treasury yields. I don't buy that it's like deficit and debt related. I feel like it's changing outlook for inflation and growth. What do you think?
I think it's some combination of all those things. Look, I think, I'm thinking of writing a piece for next week with a headline, The Doge Boys versus the Bond Vigilantes, or the Bond Vigilantes versus the Doge Boys. You might recall that back in the early days of Clinton, he was warned by Robert Rubin and James Carville that he had to placate the Bond Vigilantes. He couldn't annoy them, and he had to have fiscal discipline. And I think the bond vigilantes have pushed bond yields up 100 basis points since the Fed lowered interest rates by 100 basis points on September 18th. So the Fed funds rate's down 100 basis points, and the 10 years up 100 basis points. I think that's a pretty strong message from the bond vigilantes.
But when you say bond vigilantes, aren't you referring to the investors that are pushing fiscal discipline?
Yes.
So that's what you think is happening here?
I think a lot of it is.
I mean, since the Fed cut rates, hasn't it been just that that the economy has done really well, better than expected, that inflation outlook has gone up in light of the election and in light of the easy monetary policy?
Sure. But it's all related. I mean, inflation and fiscal policy and monetary policy are all clearly related. And as I think what the bond vigilantes are saying, look, we just went through a couple of years here where monetary policy was tight, and yet fiscal policy was so loose that it triggered inflation. And it took a couple of years of tight monetary policy to bring inflation down. And now that inflation is down, does it really make sense to have easy monetary policy and easy fiscal policy? Clearly, the Trump administration is going to push for a continuation of tax cuts. And, how the Doge boys are going to come up with $2 trillion in spending cuts. And by the way, they haven't made it clear. Are they talking about a 1-year cut, or are they talking about over the next 10 years? Usually the CBO, the Congressional Budget Office, when they look at things, they look over a 10-year period. I could see them doing it over 10 years, but 2 years, but 1 year, I don't think that's very likely. So I think the bond vigilantes are concerned about inflation. They're concerned that the Fed is easing, stimulating an economy that doesn't need to be stimulated. And they're not convinced that the Trump administration is going to do much about the fiscal outlook.